Hello and welcome back to the channel. This is Chapter 2, General Insurance. I know these videos may seem boring, but this is information that you must know in order to pass the exam. Insurance protects people and businesses against certain losses by transferring the risk from individuals to a group. Risk management, managing risks, rather than just paying premiums to an insurance company, a process designed to systematically manage the pure risks of an organization or individual. Risk, the chance of financial loss, or the uncertainty of loss. There are two types of risk, pure and speculative. A pure risk exists when only the chance of loss is present without the potential for a financial gain. For example, the chance of loss that is present every time someone drives a car. Of the two types of risks, only a pure risk is insurable. A speculative risk is when a chance is taken that may result in a financial gain. For example, gambling or investing money in the stock market. Hazard, any condition that increases the chance of loss or increases the frequency or severity of loss. Physical, moral. Exposure, the possibility of loss caused by surroundings. State of being. Peril, the event that causes a loss. For example, fire, lightning, windstorm. Loss, the reduction in the value of an asset and the financial consequences of a reduction in value of an asset. There are two types of losses, direct and indirect. A direct loss is a loss incurred as a direct result of a peril. For example, if a house is destroyed by fire, the house would be a direct loss. An indirect loss is any loss that is a consequence of the direct loss. For example, after a house has been destroyed, the owner will have additional expenses, such as hotel costs and the cost of eating at restaurants while the home is being repaired. Methods of handling risk. Sharing the exposure to a loss with another person or organization. Transferring the financial impact of a loss to another party. For example, insurance or a lease agreement between landlord and tenant. Avoidance, eliminating the risk entirely by disposing of an existing exposure or not assuming a new one. For example, not buying a home in a flood zone. Retention, absorbing all or part of the risk involved with a particular exposure. For example, an insured reduces premium by retaining more responsibility. Example, deductibles or not purchasing earthquake insurance in California. Reducing the severity of losses that do occur. For example, discounts for a homeowner's insurance policy as a result of having a fire extinguisher or car alarms for auto insurance. Adverse selection. The selection of risks against the interest of the insurance company. This is based on the fact that poor risks with higher chance for loss apply more frequently for insurance. This is the reason for underwriting function exists. Law of large numbers. The greater the numbers, the more accurate the statistics will be that permit an insurer to predict the frequency and severity of losses and calculate a premium to spread the cost of risk among all policyholders. Reinsurance allows an insurance company to sell part of the risk they have assumed from a policyholder and thereby write more insurance and protect the company from any large losses it would not be able to handle on its own. Chapter 2 has a lot of terms that you need to know in the insurance industry. This chapter will have a part 2 and maybe a part 3. I recommend making some flashcards and study them for at least 15 minutes a day. Whatever you have to do to retain the information. I definitely recommend a class because they give you exam simulators which give you some questions similar to the ones on the Texas exam. Hopefully my videos will help you in passing your exam on the first try. Types of insurers. There are several different types of insurers and different ways to classify each type. Primarily, we can differentiate insurers by how they are formed or organized. Stock companies. Insurance companies are owned by stockholders. They charge non-assessable fixed premiums. If the company creates a profit, they may be paid to the stockholders through dividends. Mutual companies. Insurance companies are owned by policyholders. Mutual companies can also pay the policyholders dividends when the company creates profits. On the other hand, A mutual company can also assess policyholders to obtain additional funds to keep the company solvent. Regulated taxes. County mutual companies. Used for high-risk auto coverage and low-value dwelling coverage. No new companies can be formed after 1954, and they do not have rate regulation, which is the main reason for using a county mutual. County mutuals are not members of the Texas Property and Casualty Guarantee Association. Farm mutual companies. Used for rural or urban dwellings, but the majority of the business must be written in rural areas. The words farm mutual must appear in the name of the insurance company. The company is not allowed to use more than 33% of its income on general expenses. Free of rate regulation. Reciprocal exchanges. Similar to mutual companies because they are technically owned by policyholders. Operated by an attorney-in-fact, parent company guarantee, and normally created by stock companies to escape regulation. Risk retention groups. Entities formed by similar businesses to insure each other's commercial and professional liability risks. Rates are not regulated. They are a provider of insurance and must be licensed. Purchasing groups. Entities formed by similar businesses to insure each other's commercial and professional liability risks. Rates are not regulated. They are a provider of insurance and must be licensed. This will conclude Chapter 2, Part 1. I do not want to overload you with information, so I will keep the videos short so you don't get bored. Just know that the Texas State exam is 150 questions, and knowing this information is key. You want to pass on your first try and not have to worry about taking it a second time. Please don't forget to like, comment, share, and subscribe. Thank you.